co-founder and co-chair of Harvard Alumni Angels India and has more than 7 years of venture capital experience in the country, most recently at Indo-US. So I'm going to hand it over to Raj to take the session forward from here.
Thank you. Can you guys hear me? Mic on? Yeah, cool. Great. Hey, good morning, everyone. Welcome to an interesting topic, future of venture capital. So we'll just get started. I'm going to do very quick intros of the lineup that we have here. We have a very interesting, diverse mix of panelists. To my left, Bharti. Bharti's with Seed Fund. Seed Fund, as many of you guys know, has been around for now its second cycle. $70 million under management, India focused. To the left of Bharti, we've got Sasha. Sasha is with K Capital. He's been one of the early angel investors, founder of Mumbai Angels, and at K Capital he has $25 million under management, so early stage focused again. And then we've got Sanjay. Sanjay is with Bloom Ventures, and Bloom has been around for now how many years? It's been about two years. $20 million fund, again India focused, and then we've got Nagraj. Nagraj is with Qualcomm, and he oversees Qualcomm globally across 7 different regions, including India. And I don't actually have a fund size here because it's an unlimited fund size. He's the typical deal size will range from $500,000 all the way up to about $5 million, typically focused around Series A investing, as I understand. So to kind of get started, we've got a very diverse mix here, and I'm going to try to keep this as engaging as possible. We'll have about 10 minutes or so towards the end for Q&A from you guys. I think that to kick this off, it's important to recognize that in India we are probably about 7 or 10 years behind a mature ecosystem such as the U.S. or Silicon Valley in particular. And I think a lot of the trends that we have seen from the Valley make their way to India in some way, shape, or form. And one of the, I guess, questions I want to throw out here, and this is probably a question more appropriate for Bharti. This is our third fund, and so the question is, if you look at the last cycle that we've been through, Bharti, what are the 1 or 2 key lessons that you would say from a VC perspective will be relevant as you take this next fund forward for Seed Fund? What would you do differently as a VC?
I think I've been investing since 2000, so it's about close to 13 years of investing in early stage companies. So all my learnings are not just from Seed Fund, it's from Infinity as well. And the couple of learnings that we carry forward, I think, which have proven right and we carry forward, relate somewhat to the funding. The first lesson that we learned was, companies may not die of starvation, but likely to die of indigestion. So I think the amount of funds you raise as an early stage, it cannot be a huge amount of money. A lot of companies, very early stage companies, raised in 2000, even in 2006, $2 to $3 million, well before proving their model, and I think that increase the probability of their failure than increasing the probability of their success. I think second lesson that we continue to carry forward and will carry forward to our following funds is that the entrepreneur needs to be where his or her markets are, as in where his or her first markets are, and we need to be where entrepreneur is. So willy-nilly that leads us to investing in India markets focused companies. We have when we started investing in Infinity, we were looking at global companies, companies targeting US enterprises. Very quickly we realized we didn't understand that market well, and our entrepreneurs need to be where their customers are. So I think that's one lesson that we continue to carry forward to our fund. And the third lesson, which is perhaps more recent, is I think it's important that companies be very capitally efficient for it to create value across all stakeholders, especially in the early stages of the company, as in frugality wins any day over throwing money. Throwing money at every problem does not solve any problem, in fact. That I think is more lesson out of Red Bus or a Vatsalya or Karwale. where I think the returns have been very good for all stakeholders because the company was very capitally efficient and very prudent about how they spent it and spending it on the right places.
Great, excellent. Sanjay, question for you. If we think about the competitive landscape in India, now we've got angel groups that have come up in a very big way. It's a very robust ecosystem of angel groups. We've got accelerators. We've obviously got micro funds such as yourself. How do you see this playing out over the next 3 to 5 years in terms of competition?
Right. I think it's a very interesting development. Thanks to IAN and Mumbai Angels, which Sasha co-founded. I think the space, let's say about 5 years ago, was quite neglected, right? It was very open, and there weren't really any sources of capital to go to. It's interesting that there is a whole layer even below microfunds, right? You have incubators, you have accelerators. I think, just bringing the cross-border angle, I think one reason you see that is in the US very often if companies get seeded, it's very easy to get from point A to point B, so you get straight to Series A. I think India, we have a lot of other challenges. So yes, there is a market. I think we just have to make sure, like Bharti said, that there isn't a glut of capital also, because if you have a lot of capital around, you have companies getting funded that may not need funding in the first place. So I think it's interesting, but we've just got to make sure that it doesn't it doesn't become oversupply. But I think in general it's a good thing that entrepreneurs have additional sources and many sources to go to.
Sure. If we look at the Valley, I think it was the year 2000 when we saw about 1,000 active funds. And if we look at where we are today in terms of active funds in the U.S., it's shrunk drastically. We have 200 funds. And again, kind of a follow-up question to that is, do you see a consolidation? Do you see a shrinkage in the market when we look at kind of the next 5 years? Are we going to start seeing fewer funds? I don't know how many we have today in India. I'm going to guess it's probably north of 50. Are you going to see, are you expecting to see a consolidation of the VC funds that we have today?
I think Sasha and the other panelists can also, sort of address this. I think very often you see seed funds that evolve and become larger funds. Right? You've seen that in the growth capital stage where you just you start managing sort of larger assets under management. I think a lot of us like this space. We've entered this space because of self-selection. There will be consolidation. I think over the next couple of years, and but in general, I think we need a vibrant ecosystem, and I think we have that. In addition to funds, I think we also need an ecosystem that's not related to capital. So mentoring, accelerators, incubators. I think they play a very valuable role. Like what NASCOM and TIE is doing. I think that's also important. It's not just capital.
Yep. Yeah. Makes sense. Sasha, question for you. I guess just building off of that, I think today, if you were to speak to most VCs here, I think one of the concerns is the quality of deal flow, not the quantity, but the quality of deal flow. And clearly, I think what we're seeing from the Valley and other more developed entrepreneurial ecosystems is this amazing rich quality of deals that are getting, companies that are getting funded. What's, from a kind of a K Capital perspective, what are you seeing and how are you playing in that ecosystem? Are you starting to look at cross-border, and if so, how?
We have, Raj, three buckets of investments. One is the India consumer story. The second bucket is we decided to do a few deals, very few, because as Bharti said, managing these deals is very difficult, which are US deals, which are purely born and brought up in the US companies. And the third bucket is one that has now become very common. It's Indian companies which start here in Bangalore or Chennai, but realize that the market is in the US, as Bharti had mentioned, which have now started moving to the US as well, which is a challenge because we are an India-focused fund, and suddenly a whole bunch of our companies are now sitting in the US. So we have to now figure out how to manage these companies, which have US markets, US customers, US everything. Or if not US, then global. But that's the reality, and that's what we have to do. And we've seen that actually a large percentage of our companies are now moving. Just in the next 4 or 5 months, we'll see at least 5 or 6 companies from our portfolio move to the US. One has already been funded with large amounts of venture capital money. 3 or 4 of them are going to go through the accelerator route. One just graduated from Techstars, Seattle, last week. So that's how it is. So it's too early for us to tell, but in the next 6 months, 1 year, we'll have a little better picture.
How are you finding in terms of the companies that you're funding before they get to a Techstars or before they get funding from a US VC, in terms of managing those companies? Sitting in, your team is in Mumbai. How are you finding that? That's got to be a challenge.
Yeah, those companies are mostly here in India.
Oh, they're here. Okay.
Yeah, and then we move them out.
Got it.
Because we realize that, as Bharti said, you have to be where the customer is.
Excellent.
If the customer's in the US, then you have to be there. And that's one of the learnings as well, is if we fund, then we're going to make sure that the entrepreneur is ready to go to the US. He or she doesn't have a family issue or a wife saying, I don't want to go to America or whatever, because it becomes impossible to run this company from India.
Right. Absolutely.
Or husband.
Or
husband.
Sorry. Yeah. Exactly. So interesting. Qualcomm perspective, right? You have a very interesting role where you're looking at 7 different regions internationally, including India. And India is obviously a kind of a key market. How are you seeing cross-border deals? How are you seeing what's happening in India play out over the next few years in terms of the types of deals?
Yeah, so I think India is definitely a key geography for us. We were fairly early on here, especially in the technology sector, 2007-ish. But I think a lot of the comments here in terms of cross-border, we have actually seen that pattern in other places. So, for example, we've been early in Israel and Europe, and a lot of the entrepreneurs have done exactly that, which is they realize that if it is not a sort of a completely consumer play that plays to the local market, they have to go where the market is, and the US is definitely one of the key markets. And typically the way those have been managed, for us it's somewhat easier because we are a global fund, and so if the company we fund in Israel goes to the US, then we just manage it out of the US. Wave was a great example, a company we found early on in Israel. They clearly realized very quickly that they had to move to the US, the CEO moved, and we were able to manage that very well out of the US. It's no problem. But I think a lot of for example, the local funds, whether it's in the UK or in Israel, what they've done is essentially teamed up with the Valley VC. So at least you can cover board meetings, you can sort of don't have to sort of fly to the US for everything, and then sort of, what you do is you typically have half and half. You may have half the board meetings in the local geography and half in sort of where they move to, especially in the US. So I don't think that trend is going to slow down. I think a lot of the companies we see in India are more technology oriented than some of the other regions we cover. Like, for example, in China, we see less of that phenomenon. There's a number of exit opportunities within China, so we haven't seen companies sort of move out of there, and the local market is sort of big enough to support a number of companies. But I think clearly in places like Israel, and I think increasingly in India, we'll see a lot more of that.
Right.
Raj, I just want to add to that.
Sure.
From our portfolio also, we have at least, I'd say 25 to 40% either moving or considering moving. And, we're going to talk about the ecosystem later, but that's where, the funds ecosystem also comes in. I think the larger funds can either partner with larger VCs or have their own teams in the Valley or, in Singapore, for example. But, smaller funds or micro funds have to create those ecosystems, because those companies are going to come back to us and say, I'm moving to the Valley, can you help me? And how can you help me? What are the linkages and networks besides the capital?
Right.
So that's very important also.
Absolutely. It looks like, clearly there's a theme here around cross-border, and I think we're going to see that play out going forward. Just to switch gears a little bit, we're starting to also see an influx of vertically focused funds. So an example would be the Hive, right, focused on big data. How do you, maybe you can take this question around, how do you see folks like K Capital and the other funds in the ecosystem here compete with funds that are now going to be very focused on certain sectors or certain areas of technology?
So my view is that India is still too early to do too many vertically focused funds, in my opinion. There's just too many opportunities. Maybe I'm greedy, but at least for the short term, for the next couple of years, there's enough and more opportunity. As you said in your previous question, will VCs, what will it shrink? So my answer is not really. There will be some firms who don't perform. Like if K Capital doesn't perform, we will shut down. Simple as that. But there will be new firms coming. And as the future, as it goes in the future, there will be vertically focused funds as well. But even in the US, you look at Andreessen Horowitz, everyone here knows them. And they came in so late to the party, and they're right on top of the game. They get all the deals that Kleiner gets and Sequoia gets. So the reality is that you can innovate and have really good management as far as partners and firms and come in. Sure. Or I had coffee with 3 seed funds in the Valley 10 days back One was Homebrew, raised 35 million from top tier investors, and two others that are actually not yet launched but will be announced in the next few weeks. So even in such a crowded market, you're getting venture capital firms, and when I asked them what they do, they were not vertically focused.
Got it.
So I think there'll be a good mix, and Hive is great. Arihant and his colleagues will be focusing on big data, so it makes sense.
Yeah.
But for India, I think there's no rush to vertically.
No, fair point. Excellent. Another question, Bharti, this is more perhaps appropriate for you to take, is, despite, in India, I think we've talked a lot over the past couple of days at NPC around limited exits, right? We were all kind of under this, tremendous pressure to now have more exits in the ecosystem. How do you see GPs being able to raise follow-on funds in this tough environment where exits are so few? Is this going to become a bigger issue going forward? Are GPs still going to be able to convince LPs to, and LPs again, just to kind of set the context. So LPs are the investors that put funds into venture capital funds.
I think it's not just the GPs. I think it's not good for the entire ecosystem that we don't have so many exits. We need to have more Indian buyers, Indian companies buying Indian technology companies. We need to have Indian consumer internet companies buying other, whatever exists. We have seen it, Seed Fund, which is Carwale and Redbus, both have been in overseas acquirers. So I think it's going to impact, it is already somewhat impacting overall the ecosystem. There are a lot of LPs who are saying, where are the exits in India? They see exits in China, they see exits in Israel, and one of them recently, a month ago, told me, US funds are making so much more money, why should we invest in Indian funds? And he was somebody from UK with large amount of capital under management. So I think exit is really, and that's something that waxes all five of us sitting here. How do we, make sure? The way we look, whenever we evaluate any company, any investment opportunity, the first question we ask is how exitable this is. Will there be somebody who might acquire it? And often we don't know the name of who might do that, or will this go for an IPO. I think fundamentally we believe that if there is a company that has something that is highly differentiated or unique about it, it creates value. It creates value for all its stakeholders, whether employees, entrepreneurs, and investors, in terms of somebody will find it valuable enough to acquire.
Sure.
So I think it is very important as an entrepreneur, if you're sitting there thinking about how do we get money out of a venture fund, I think it's very important to think through what is your unique positioning, what is the key differentiator that allows you to build value in the company and therefore helps all your stakeholders win in the game.
Sasha, do you want to add to that?
Just to add to that, as many people in the audience will probably know, when you're a fund manager, Fund 1, tough to raise, but Fund 2, you can't really show exits because it's generally 2-3 years at best before you go back to the market. So what you have to show is a couple of things. One is up rounds, you get quality VCs to write checks into companies that you've invested in. And even more importantly is the quality of entrepreneurs and teams you bet on. So the good investors would actually come and meet these companies and say, okay, did you tell us that you would do this, and invest in such companies? Is your strategy the same as when you told us? If it's by and large the same, and if it has changed, have you communicated that to us and taken our buy-in? If that is okay, they'll be happy to invest. Fund 3 is when the game really starts. Because by then you can't be butchering it around because it's either good or bad. So you then say, okay, it's been 8 years, now let's talk. And let's talk Turkey and let's talk numbers. And if you can't, there's nothing to discuss, it's right there. And at that point of time, Fund 3 becomes very, very difficult to raise. The only time you can get away with Fund 3 as well, I was talking to a friend of mine the other day who got away with Fund 3 as well, is when the market was so good that they got it raised without really running around. Now, you can't really depend on a hot market because you can't time it. That's not the way the world works. But they got it done. But generally, the thumb rule is Fund 1 is a barometer of Fund 3. And after which, then, of course, the story goes.
Sure. No, excellent. One question, sorry, Sanjay, go ahead.
No, just quickly, on the topic of exits, I think, about 5 years ago, you could count the number of tech exits on your, one hand or two hands. And I think after Make My Trip, there was a lull, and now you had Just Dial and you have Redbus, from Seed Fund. And I think that's great. We need many more of those. I think the second point is that traditional up rounds to Series A have always been, the best barometer of a VC's venture program. I think we're seeing I think strategics are interesting, another option also, because they're looking at India very strategically.
Sure.
If you look at Redbus's exit and lots of those. And also, again, cross-border. So I think, as VCs, we have to look at alternative sources of exits as opposed to just the traditional up rounds.
Absolutely. No, fair, excellent point. Nagraj, one question for you. I think, again, we're looking at the future of venture capital, and I think one of the trends that I've seen coming from the Valley is that increasingly funds from the Valley are looking to disseminate more information to the portfolio companies, to make knowledge transfer easier, where the knowledge is just not sitting within funds, but is actually sitting and being shared with their entrepreneurs, with their companies that they're backing. And one example, I think Shaker talked about this a little bit from Axel yesterday, which is being able to share information, research information, market information with entrepreneurs more frequently in India than we've been doing traditionally. I guess, just from kind of Qualcomm sits in a very unique position, very global in nature. What are you seeing? I mean, I guess, why are we not seeing in India more VCs being able to share market information that can benefit entrepreneurs?
I think one of the funds that was mentioned in recent Harvard's, one of the reasons for the success is actually they've turned the VC model around a little bit, because they've got more people in the firm that actually are dedicated to helping entrepreneurs than actually are investing. So they have 6 partners, but they have a team of almost 15 or 20 people that essentially their only job is to help disseminate information to entrepreneurs, but also do things like do dedicated recruiting for them, dedicated business development, and then a relationship with corporates. So we are seeing the model change even in the US. I don't think every fund can afford that level of help to the portfolio companies, but clearly that function of helping portfolio companies in a more systematic manner is being recognized as being key, not only to get the good deal flow, but ultimately to get good exits, because a lot of the learnings from one company to the other, if they're shared properly, can really help the company grow and give good exits. So we, as a corporate, also have a lot of information, both from a strategic perspective, but also from our 13 years of investing. So we've also set up a dedicated, almost like a business development team that does no investments, but their sole goal is to help portfolio companies with whether it's research data or connection to our partners or connection to other VCs. And I think that trend should hopefully come to other regions, because it is very, very valuable, both from getting a competitive deal flow, but also, as I said, to get to exit. It's just a question of economics in a VC firm as to how much of that can you support, given sort of, the small fund size, and smaller funds obviously have a little bit of a harder time supporting that kind of activity. But I do think that's critical going forward, and it will lead to good outcomes for everybody.
Excellent. We just have a few minutes left, so I think one of the questions I want to ask, and then we'll throw it out to the audience, Nabil Ravikant, who's the founder of AngelList, made an interesting comment, which is that now with players like AngelList, you don't have proprietary deal flow. It just doesn't exist anymore. And on the flip side, you have Bill Draper, an iconic venture capitalist from the Valley, saying that we have too many funds chasing too few deals, and it's going to just kind of create a the equilibrium is going to be shifted between funds that are going to take on a lot of risk and entrepreneurs who will actually take on less risk. And I'm just wondering, from a kind of an India perspective, now that you actually have players, AngelList, in fact, earlier this morning, I met a new company that's actually trying to create AngelList for India, right? So how is that going to now shake up things for us in India going forward? Which kind of school of thought do you guys ascribe to? Open question, whoever wants to kick it off.
I think very encouraging what AngelList has done. They've really shaken things up. It's very disruptive. Anybody in this room can apply, and you can get an investor sitting in Iceland who could be an outstanding investor, and he or she could invest in your company. One of our companies is on the first page of AngelList this week, so I'm very excited about that. And only time will tell in the next week if they get funded. But they're sitting in Seattle, and they could get potential money from, like I said, from Iceland. So what's the problem? I'm meeting the same company you mentioned right after this. So I'm looking forward to meeting them as well. And I've been talking to them for a couple of weeks. I think everyone can coexist, is my opinion. But a lot of VCs in the Valley, when I met 2 weeks back, were a little bit skeptical about AngelList. But I think my view is that they will do better than most people think. And, we should watch out, because this is a very efficient way to do things. And I guess, like I said, there will be a coexistence, but a lot of the lower level VCs can get wiped out. if they don't watch out with disruptions like AngelList and other disruptions in the venture industry, like Andreessen Horowitz, as you rightly mentioned, where they don't look at themselves as a VC firm anymore. They took Michael Owitt's model of CAA and said, we will do a creative artist type model. And they actually have Michael sit in the office. And that's how new firms come into the picture and kind of disrupt things.
And like you said, there might be ways to partner with platforms like this. Bharti, did you have a thought?
I think what Sasha is saying is true. I think it's good to have a lot more players. I think India can afford many more early stage funds, accelerators. We have so many more entrepreneurs coming up. From the way we've seen I've seen it grow from 2000 when we had the first wave of early stage funds, and a lot of them moved on to being later stage funds because the kind of work required in early stage was different, to 2006 when there was nobody around when we launched Seed Fund, to now. I think it's a lot more work for us, which is good, keeps us on our toes. It's nice to have a lot more competition, validates our model as well, that smaller early stage funds do work in India. And I think the more AngelList or India creating its own AngelList or Mumbai Angel funds, all the funds, they do spur the activity a lot more as well. I think we will all coexist. The more accelerators are there, we coexist with them, with the early stage funds. Yes, we do lose some proprietary deals, but that's the price that we are okay to pay for growth of the industry itself.
Sure.
I think the one challenge with a lot of the early stage, which we've seen in the US also, is there is a heavy dose of funding at the very early stage. It does get a little challenging. The funnel becomes pretty steep sometimes because raising a Series A is getting a little harder, and only because, as you mentioned, the number of funds have actually gone down significantly. So we are seeing a concentration of money in the top tier funds, and a lot of the tier 1.5 to 2 funds have either gone away or have shrunk dramatically. Some of the new fund sizes are half of what they raised last time. Yeah. So when this amazing number of companies are funded and the top sort of come to get their next round of funding, it is incumbent that the ecosystem be able to support that. Otherwise, you'll just have a number of folks that got started but didn't go anywhere.
No, excellent, Nagraj. Thank you. So we just have a few minutes left, and I'd love to open it up to questions. Sid.
I had a question about so as the market evolves, how do you see the role of the classic sort of large check Series A kind of funds evolve? There's obviously a concentration of the funneling because you guys are funding a lot more firms now. And then there seems to be either call it a Series A crunch or whatever. But from a VC's perspective, how do you see the classic $300 million fund that's used to writing, 7-10 million Series A checks evolve in the current time frame, 2013?
I don't think I got the question.
Is it business as usual? Is it the same as it was when you started Seed Fund? Or is Accel or Helion or any of the bigger names are doing something different? Because the ecosystem's changed, the number of companies that have been funded has gone up, and yet the cost of doing a validation has come down significantly. So the sort of initially 6 years ago when I did my first startup, the first thing was go to a large fund and get 10 million. Today there's a different path to that. So what has that meant for the Accels of the world and for the Helions of the world?
I think they have well curated startups. I mean, Series A companies. If a lot of them are coming out of accelerators or early seed funds or early stage funds, a lot of work is done for them in that sense. But I think the way I see the market, what has been happening, I'm not sure the $300 million guys are only doing Series A or $10 million investments. I think they're doing $1 million investment as well. I don't know the reason why they're doing that, but I think it's good for us if there are a lot more $300 million funds. I'm not sure I answered your question.
No, so let me try to take that. So I think, look, a lot of the global funds actually have carve-outs globally that they are deploying for smaller ticket sizes, smaller deals globally. India is one of the markets. So, that's something that different funds have taken different points of view on. Some of them have scaled back, some of them have accelerated that. But we're going to continue seeing that. And I think it's part of, their way of staying connected to the ecosystem. And it's low risk. These are small checks. Another question?
We're just running
Yeah.
out of time. So
Yeah.
that's one last question.
One last question. Sorry.
I just have a question. This is more to put things in perspective and kind of compare with a model that already exists and has been fairly successful in US. I've been there for 12 years in Bay Area especially. One question is the opportunity well defined for venture capital in India, for example? In US, you have a good demand system in the form of Fortune 500 companies, 90% of them based out of there, the enterprises. And you have a well-defined consumer market where a technology, whether it's a B2C or B2B, can go in there. And more importantly, as part of the ecosystem you have well-defined, good quality entrepreneurs coming with good product background, management background. You have access to great education system. My point is...
What's the question? Sorry.
My question is, if are we blindly repeating that model here, assuming certain things? I feel a lot of those ingredients are missing in the Indian market, whether it's Fortune 500 enterprises or that kind of stuff. Yeah. So,
Sanjay?
It's a great question. I think we talked about cross-border, and one of the reasons that's also happening is because there's been a lack of depth of the domestic M&A market. Right? You don't have the equivalent of the Fortune 500 companies here that are actively out buying tech companies you're looking at. You don't have the equivalents of the Googles, Yahoos, Facebooks. So that needs to change, and as a result of that, exits have been outside India. But I think through the solution is through corporate tie-ups, what NASCOM is doing, and just collaborating more strongly with corporations India is needed. I just wanted to address your question. There's a panel later where Sequoia and Helion are on, so you can ask them that question. Seriously.
So I think the only thing I'll add is that we've seen two. I think some of this just takes time, but I think the two models we have seen is we've already mentioned Israel, where basically from day one they just say the market is outside the country and they focus on that because it's very tech heavy. I think in China you also have actually a lack of M&As from just like the US, but what they've been able to do is they've been actually able to scale very well to go to IPO. So I think the IPO market there is much more robust and there's a lot more exits in the public markets. I think the M&A market I don't think is healthy like the US in any other part of the globe. So I think it's kind of hard to believe or hard to expect that to happen almost anywhere. So I think the exits, whether it's the cross-border ones or the ones where I think the domestic ones will get IPO, that's I think the only two real paths I see.
Great. Excellent. I hope you guys found this engaging, and if you have more questions, we'll be outside. Thank you guys.
Please provide feedback on this session.